Hi everybody, this is Ellman, the blue collar investor, with today's covered call writing question of the day. And today's question comes from James, who has a question regarding the rolling down exit strategy. In August of 2012, I purchased ABC stock for $5.46 per share and sold the February 2013 $6 call. I generated a premium of 33 cents. Now, today's date is January 15th, 2013. The stock is trading at $5.62, and the bid and the ask is 2 cents and 3 cents, respectively. Now, the stock is out of the money, but quite a bit above the initial purchase price. Is this strike a reasonable option to roll down? If I do, I must pay the commission to buy to close the contract and pay another commission to write a call for the February 2013 $5.50 strike. That bid is 18 cents per share. Okay, James, let's first review the trade that you just described. You bought ABC for $5.46 and sold the February $6 call for 33 cents. Now, since the $6 call is out of the money, it's all time value and therefore all initial profit. So your return initially was 5.5%. So far, so good. Now, on January 15th, the stock is trading at $5.62, above the purchase price, but still below the strike price you agreed to sell your shares for. The bid-ask spread for the $6 call is 2 cents and 3 cents, and the bid price for the $5.50 call is 18 cents. So let's take a look at the math and do some calculations. If you closed your original options position, you go to the ask column, and it would cost you $3 per contract. That would be your debit for closing the position. Now, if you sell to open and roll down to the $5.50 call, you would generate a credit of $18. So net, you would have a credit of $15 if you roll down to the $5.50 strike. However, your share value would also depreciate because they're currently worth $5.62, but if you agree to sell your shares for $5.50, you've now lost $12 in share value. So we subtract that from the $15 option credit, and now you're down only to a $3 credit. And if you factor in commissions, as you stated in your question, to close and open, now you're down to little or no profit at all. So it absolutely does not pay to roll down in this scenario. Let's take a look at some of the guidelines as to when you would use the rolling down exit strategy. First of all, this is a bearish strategy. The stock price is doing poorly, the market is doing poorly, you're looking to mitigate losses. So you would use rolling down when the stock price is declining in value. In this case, it actually accelerated in value. You would also use it when the chart technicals are breaking down. Well, when the stock price is going up, that's not the case. So using the rolling down exit strategy definitely has its place with every covered call writer, but not in a situation where the stock price is actually going up. In this case, the stock price is under the strike and above the actual initial cost. So you're doing great so far. At this point in time, I would take no action, but continue to monitor your position, and should things change, then reevaluate. Who knows, if the price drops, you may end up using the rolling down exit strategy. If it accelerates, you might decide to close your position and use the mid-contract unwind exit strategy. The key here is that we all must master all the exit strategies, know when to use them. If we could do that, then we will maximize our covered call returns like very few other covered call writers ever do. James, thanks so much for that question. Thanks to all of you out there for watching this video. And as always, this is Ellman, the blue collar investor, Take care, everybody.